Hi, everyone. This is Aruba and Stephen and Sean.
Hi, everyone.
Hello.
So because, we're in this situation where everyone's working from home, we chose to record it in advance so that we get over the content, and then we're going to come back and answer your questions. So stay tuned.
Good morning, everyone. Today we are here to talk about optimizing operational balances to maximize profit. This could not be a more important talk given the tough economic environment we are currently in. Making a profit for banks is harder than ever, and the solution we are about to go through is accessible and achievable for anyone willing to grab it. To everyone listening, please feel free to submit your questions at any time, and we will get to them at the end of our talk. Our speakers today are Sean Newland, Managing Director at Parker Fitzgerald, and Stephen Moody, VP of Customer Services at AyasdiAI. Sean has been at Parker Fitzgerald for about 5 years and brings over 20 years of experience in the financial industry to every client engagement we do together. Stephen Moody, being the VP of Customer Services, has his eyes, ears, and nose in every customer engagement, making sure all their project KPIs and goals are being met. Today, they will be your experts taking you through the journey of optimizing operational balances to maximize profit for banks. Stephen, are you ready?
Thank you, Aruba. So greetings from lockdown, Stephen here. Hope you're all staying sane. Today, we're going to keep your mind sharp with a deep dive on optimizing operational balances to generate profit. The agenda today, a quick introduction to the bottom line. Why would we want to do this? Then I'll hand over to Sean, who's going to give us a background on the regulations and how we strike the right balance between the opportunity and staying on the right side of the risk equation. Sean will then hand back to me and we'll go through the solution before summarizing and taking some questions. So, why would you want to be interested in this? Accurately measuring and managing the operational balance portion of a corporate portfolio is difficult. So many organizations resort to heuristics and potentially suboptimal classifications. And therefore, much of the corporate balance sheet may well be defined as excess balance. If we can optimize the operational balance portion, we can release more cash for more profitable usage. And roughly on an overall book with circa 10 billion in balances, this optimization can net a profit measured in the tens to hundreds of millions. And in this presentation, we'll show you how we've used a machine intelligence explainable AI project to achieve this. So I'm now going to hand over to Sean, and he's going to walk us through the background of the relevant regulations and constraints.
Thanks, Steve. Over the last few years, banks have built up a considerable war chest of highly liquid assets on their balance sheet. This is partly down to the need to meet minimum regulatory requirements, of course, in particular the liquidity coverage ratio, or LCR, which was introduced under the Basel III reforms. This seeks to promote banks' short-term resilience to liquidity risk shocks. As you can see, though, on the chart on the left, globally, banks are now holding substantial buffers of highly liquid assets over and above the minimum regulatory requirement. The average LCR, for instance, for Tier 1 banks was 36% by mid-2019, according to the latest BIS calculations. So taking the top US banks alone, this equates to nearly $400 billion of surplus holdings of highly liquid assets that might potentially be released for other purposes. So why are these highly liquid assets being held? Well, first and foremost, they serve as mitigants to the risk of short-term cash outflows during a market stress situation. Whilst the minimum coverage level was driven by the Basel III rules, the additional discretionary holdings provide an extra level of comfort for banks against the risk of falling below that line. The additional liquidity buffers might also be said to provide banks with flexibility to respond to the heightening of other financial risks, such as credit risk deterioration or defaults. But could erring too far on the side of caution be detrimental to the business if some of these liquidity reserves could be released safely to be invested in higher returning assets or revenue opportunities? Banks need to strike the right balance between capitalising on such opportunities whilst maintaining an appropriate safety net for times of need, aligned, of course, to the level of comfort around current and future risks. On the face of it, the calculation of the minimum liquidity coverage ratio appears fairly simple. The Basel rules for LCR require banks to hold high quality liquid assets, or HQLAs, on their balance sheet sufficient to cover the potential risk of net cash outflows in a market stress event over a 30-day time period. But calculating this across a portfolio of customers can lead to significant variances in reserving outcomes. This is because very different coverage factors apply dependent on perceived risk of flight of different types of balance. For instance, if we take a look at the coverage requirements for corporate customers, which are often the bedrock of customer liabilities on the balance sheet, the difference in the reserving factors is really quite stark. Customer balances required for operational needs, for the customer's business, for instance, for payments and settlements and the like. These are deemed to be relatively sticky or less prone to flight in a market stress situation. So these only require 25% coverage. However, the non-operational balances, also referred to excess balances, are considered much more at risk of outflow and hence attract a 40% runoff factor. At the other extreme, a balance held on fixed deposit with a period notice period greater than 30 days falls outside the window of risk altogether, so requires a zero coverage. In practice, what do all these different risk factors mean? Well, here's a simple illustration of two portfolios of commercial customer balances, each totaling $100 million. As you can see, the mix between the different types of balances and the net cash flow outflow calculations make a big difference to the overall reserving. Scale this up to the size of commercial deposits on a global bank balance sheet, and clearly the variation in coverage can be quite substantial. So, if the profile of customer balances can be moved towards a more optimal mix, reducing the cash outflow risks, then the economic incentive is pretty clear. It will enable the safe release of excess liquidity reserves, quite literally putting money back into the business for more profitable use. So what do banks need to do to strike the right balance? Well, the key steps are, firstly, to understand the appropriate level of liquidity reserve coverage, both to minimise the risk of falling below the minimum regulatory requirement and also to align to the institution's risk appetite. Banks then need to categorise, monitor and proactively manage different types of customer balance to optimise the mix and reduce the potential risk of net cash outflows. In doing so, they must ensure complete explainability so that methodologies and models for calculation are transparent and defensible. And finally, it's important to recognise this is not a one-off exercise. Dynamic optimisation of customer balances needs to be embedded into operating models sustainably as customers' behaviours and market factors continue to evolve. But it's not necessarily easy to get all these things right. The essential first step is to achieve and maintain an accurate classification of operational balances versus excess balances. Getting this wrong can have very negative impacts. The regulation, in fact, states that if banks are not able to determine the amount of the excess balance, then the entire deposit should be assumed to be excess to requirements and therefore considered non-operational, attracting, as we've already seen, a much more conservative reserving factor. So once over the critical hurdle of how to classify balances accurately and reliably, there are a number of further complications to consider in how to manage and operationalise this. Firstly, there's scale. Global banks need to solve this in a consistent way across multiple jurisdictions and many thousands of customers. Sustainability. Customer balances are dynamic. They will vary over time as circumstances change. So the methodology must remain relevant and reliable over time. Effectiveness. The opportunity to improve the mix of balances and the outcomes of taking any actions to try to do so will vary by customer too. So it will be key to focus remediation efforts on the materiality of the potential upside and on the probability of success. And finally, practicality. Any remediation actions will potentially need to be widely federated across an extensive number of frontline customer relationship staff. So simplicity of process and ease of use tooling will be essential to embedding the approach into business as usual. With that, I'm going to hand back to Steve now, who's going to take you through a solution that addresses all of these difficulties.
Thank you, Sean. So now we have the framework. Let's drill into what an operational balance is in some more detail. A typical account balance on a corporate account might look something like this. There is a cyclical and volatile portion, and there's a more stable portion. The volatile part is used to run the business, and it's called the operational balance. The remaining part is called the excess balance. As Sean has described, from a regulatory point of view, the excess balance is at risk of capital flight in a stress situation and counts as cash outflow for the LCR calculation purposes. The operational balance part is treated more favorably as it is less likely to be an outflow risk, and it's therefore more profitable. The important starting point then is that if the bank cannot accurately measure the operational balance, then the entire balance must be treated as excess balance. So measuring it accurately is therefore important. But how is this done given customer variations, volatility and uncertainty, And how do we manage and understand it on a large portfolio as it changes over time? To get the best results, we follow a 4-stage process. Step 1 is to fully understand the customer base. In our methodology, we use segmentation and discovery using topological data analysis to understand the different segments and behaviors in the portfolio. Once done, the next step is to develop and test an approach to accurately assign end-of-month operational balance to every entity. This gets us to an optimized view and a reallocation of a potentially large fraction of the overall portfolio balance. Step 3 is then to predict how these values will change in the future, so we have a view of stability and other opportunities. Step 4 is then active management. This is where we generate alerts to guide action by the bank, for example, by alerting relationship managers to the accounts they should actively manage each month. Let's go into these stages in more detail. There are several considerations when classifying operational balance, and it is complicated by several factors. The essential input is the history of balance, credits, and debits on each account. This is the raw ingredient. But to get an optimal model, it turns out there are several other important dimensions to consider. Firstly, customer segments. Will the same model work for large, high-volume accounts and small accounts, for example? How important are the effects of geography and industry type? How do we deal with large volatility and outliers in the population or in an individual historical balance profile? And how can we package the process up in an explainable way to meet the needs of the business users and regulators? It's very important to take an approach that leads to open and explainable results. The fastest route to this is by first segmenting the customer set over all static and dynamic features to get a top-down view of the population behaviors. Here, we can see a topological segmentation that has automatically identified around 20 subpopulations in the customer base. In this example, we color this by volume of activity, where a blue color indicates a high volume of activity and a red color indicates low activity. From that simple view, it's very easy to see that different groups behave very differently. Different groups carry more or less benefit for optimization. Once we have the segments, the other model inputs are average balance over various smoothing windows going back at least 12 months, the cumulative credit and debits over several different time windows, and special treatment of outliers and spikes. The resulting model then calculates and assigns an accurate operational balance at the required interval, for example, monthly. And here the example shows an operational balance which hovers around the 50% level. So 50% of the overall balance is operational and 50% is excess. Knowing this will provide an opportunity to a relationship manager to, for example, talk to that customer about moving some of that excess balance into a long-term deposit, thus optimizing the account balance. Now we have properly assigned operational balance for all the accounts, we can view an optimized view of the overall portfolio. The area in green are the accounts with high operational balance. This improvement in measurement accuracy reduces the LCR outflow value and can add very large benefits running to the hundreds of millions. The question now is, how stable is this and what will it look like in the future? We have an accurate view of operational balance looking forwards. We now need to know how this view is likely to change over time for several reasons. We need to understand how stable the operational balance is for management purposes, and we need to identify areas in the portfolio where we could make improvements. We can use our historical operational balance calculations to generate a forecast model looking 3 months ahead. And here we see a color-coded view giving us the forecast. The blue dots are the entities that are predicted to stay stable within the next 3 months. That means we think their operational balance percentage is going to stay roughly the same. The red dots are the entities that are predicted to drop in operational balance. and the green dots are those predicted to rise in operational balance over the next period. We now have a good handle on the likely time evolution of the overall picture and can make more accurate decisions. We can also generate alerts around entities that could potentially have their operational balance improved. For example, here we can see at the bottom of the chart an entity with a stable balance that is low operational balance and predicted to stay there. It also has a very high overall balance. The question is, can we improve this? Could we improve the operational balance percentage of this with an interaction with that entity? How would we prioritize actions? So imagine we want to identify the entities in the overall portfolio where a relationship manager could have the biggest impact on the overall operational balance. There are several factors that would help guide us to the right place. For example, how much could we improve the operational balance by for a given entity? How likely is it could we achieve that improvement for a given entity? And if we could, how much is this intervention likely to be worth? The overall intervention value is a product of the customer balance, the possibility of improving the operational portion, the likelihood of changing that effect, and the price advantage of operational balance versus excess balance. The tricky part here is calculating the improvement opportunity and the achievability. So let's see how we do this. Let's take an example. Imagine we want to generate alerts regarding the set of entities that are predicted to be low operational balance in the future. How do we select the best set for action? To do this, we select out a portion of the portfolio that is predicted to be low operational balance in the future and build a topological map that relates the entities to their most similar neighbors. In the map here, the blue and green areas are the low operational balance areas. This population is selected to mainly have these entities, so we'd expect it to be mainly blue and green. But notice there are some red areas that have high operational balance concentrations. These are exceptions that are outperforming expectations. And this is how we identify opportunity and value. If you have an entity that has low operational balance, but has close neighbors that have high operational balance, then there is a higher chance of enacting a change, as these entities are otherwise rather similar. And this is how we construct the optimum alerts. An alert for a relationship manager would look something like this. We can see the history of operational balance levels for the entity, and then also the forward prediction. So here we've got a history from December to May, for example, and we're predicting forward to August. This entity is predicted to drop from its level of around 50% operational balance to below 25% operational balance. The green area is the forecast for the nearest neighbors. If many neighbors are forecast to outperform this entity, there is an upside opportunity to enact change, as shown by the shaded green area. In this case, there's an opportunity to increase the operational balance by 36%. The weighted value of making this intervention, taking all the factors into account, is therefore $41,000. It turns out that when you do the calculation and rank the order of the alerts by descending value, then there is a benefit sweet spot, which is typically between 100 and 200 alerts actioned per month for a typical global bank. So this is a very manageable number of interventions each month that can generate a large benefit. Indicative numbers based on a typical large global bank would create an additional profit advantage of between $1 and $2 million per month as an annualized benefit. So now we have a way of continually optimizing the portfolio over time and managing change, as well as the initial benefit of optimizing the overall portfolio to maximize the operational balance portion. So to summarize what we've been through in the solution, we have covered the background to how and why optimizing operational balances can add potentially hundreds of millions in profit. We've covered some of the important details and considerations of an explainable AI approach, which is open and understandable by the business and regulators. And we've shown how we can generate a forward look and the generation of alerts to give the bank a continuous monitoring and optimization capability to deal with change. That brings us to the end of the presentation. Thank you for listening. And I'll now pass back to Aruba, and we can take any questions from the audience.
Hi, everyone. We're back. So we've had a couple of questions come in, and I'll just read them off and see who can answer. So is the model at entity level or account level? I think, Sean, you can answer that.
Yeah, I've got that one. That's a good question. If you look at the regulation, the lowest level of granularity it talks about is legal entity. In terms of, I guess, fully understanding customer behaviours and optimising their balances, I would fully expect there to be some incremental benefits, if you like, from going to the next level down to accounts. I guess the considerations would be around potentially diminishing returns. Steve's already mentioned there's a kind of payoff between effort and return. I think that's quite a key consideration. I think from a modelling point of view, it's fairly neutral. You could do either, or in fact, you could do both. So I think it comes down to a pragmatic decision. What do portfolio managers, relationship managers prefer to see? But I guess overall, my sense is there's usually, in my experience, enough benefit from managing at the legal entity level, the customer level. But that's the logical starting point, to be honest.
Okay. Another question we got is, how did you choose the time horizon for the look ahead? Stephen, I think that's pertaining to your slide.
Yeah, good question. Yeah, very good question. So we tried a few different time windows in different scenarios. If you go very short range, say a month, then you find that there might not be very much change. If you go too long, say 6 months, then you might lose accuracy in your prediction accuracy. And there's also the question of actionability. So we need to take into account the amount of time taken to respond to the alert and be able to take action. 3 months is quite a good time frame for that. So when you take all these factors into account, 3 months seems to be the sweet spot. You get an early warning, but you also get enough time to actually enact some change on that entity.
Okay. Another one we got is, so how do you decide when to retrain the model?
Should I take that one?
Sure.
So great question. So we trigger model retraining when there's a drift in forecast accuracy. So that's a fairly standard approach we take. That'll then trigger a retraining event and a challenger model to be proposed as a replacement. In this type of environment, everything needs to be explainable, everything needs to be transparent and understood by business. So we'll have to go through, if there's a change to the model, we'll have to go through a business review and acceptance. So that's kind of business as usual for small drifts in the model. In significant changes, you can also use the segmentation model to re-examine the population behaviors. So in a time, for example, now where behaviors might be changing significantly, you could re-examine the populations, take action on any large-scale changes that have happened in the portfolio and react and plan accordingly.
All right. Okay. Another one. Let's take this one. Okay. So implementation timescale and considerations. That's a good one.
I'll take that one if you like. Yeah, I mean, I think the answer slightly depends on where the bank is today and their evolution. As with all these things, there's a bit of a maturity curve to get through. I think just based on experience, we count on a range of say 4 to 8 months to start to realise some of the benefits of outlined today. I think in terms of the second part of the question, the key considerations, 3 or 4 things immediately spring to mind, probably echo some of the points in the presentation, but certainly the quality and availability of data with any model is a key dependency. Clearly, in a situation where there's existing normalized data that's easily supplyable on an automated basis, that's a big advantage. If it doesn't exist, it's going to take a bit longer. I think on the other side, you've got to think about the model business side. Again, there's probably some choices there depending on institutional prioritization, but if relationship managers have already got a very rich dashboard, it may be a simple path to take into that executive views and action list going. Equally, if that isn't the case, a more tactical option, I guess, would be to implement more of a standalone dashboard, pending a more strategic architecture. So there's some choices there that I think will determine the timeline. Other couple of factors would be clearly the organizational complexity, the number of countries we've talked about, the number of RMs, how they're structured, because there has to be a pragmatic kind of federation model of how this is run when it's live. And probably last but not least, it's just considerations around the actual approval and acceptance review of the model. That could be both internal and external, of course. I guess the trick there, we explained the model is designed to be extremely explainable, which I think will help immensely. But, I guess the trick is to try to bring your stakeholders along with you on that journey as you go to ensure a smooth adoption at the end. Makes sense.
Okay. So I think we're going to leave it there. We have a few more questions coming in, but we will try to reach back out and answer it that way. So for our upcoming talk, we have one on a very, very important topic for stimulus fraud. We know it's really good news for a lot of Americans, but there's also a lot of complications and things to be considered as we implement this and distribute the funds. So in 3 weeks, our CEO, Simon, is going to be giving more of a informal lunch and learn type of talk. And we'll have that up on our channel soon with all the details. So I hope you guys join us again. And I hope you enjoyed. And this was a very informative and helpful conversation. Thank you to my presenters for the time. And I hope to see you guys again soon. So thanks, everybody.
Thanks
Bye.
all. Bye.
Thank you. Bye.